Hello, everyone. Good morning and happy weekend to you. For those of you who are watching us on the Saturday stream on Facebook and on YouTube, great to have you guys here. Today is a very important topic. We are going to be talking about how out-of-state investing works and why you should be considering it. First, I want to take a little step back and address some of the people that I know out there who are living in an expensive market right now, such as San Francisco, or New York, or some places on the high end in the East Coast or on the West Coast, like up in Seattle. You may feel that the barrier to entry into real estate may be so high for you that it's almost impossible to reach because home prices are really, really high. And one of the things that you can do to kind of overcome that barrier is to look outside of your own home state. Now, I know that it seems a little bit intimidating to do, but it's actually not that complicated because everything these days are now interconnected and you can see things from so far away on the web instantly, as long as you have someone on the other end of the camera working with you out there in your markets. So I think it's really important to consider out-of-state investing. I personally started to buy real estate before I had my own house here in California. So I bought a whole bunch of properties in Indiana and in Cleveland without even having my own personal residence because that's just how great this is. One house in California is not necessarily the same house price-wise in Cleveland, Ohio, or in Indianapolis, Indiana. And so what's really important to understand is that the barrier to entry is much lower when you're looking to buy out of state. There are some things to overcome, but in general, it is a much better way to invest. And we're going to get into some of the reasons why here in just a second. So let's actually talk about that right now. Let's talk about why having out-of-state investments is much better for you than having in-state investments where you are here. First of all, we just talked about it. It is the barrier to entry. It can be very expensive. The second thing is that your risk gets cut down by a lot of different ways. Because if you have one house, you may be able to buy multiple for the same price as one house here in California or in the West Coast or in the East Coast. And so that way you have a portfolio effect. So that if something happens with one of your properties, you'll be able to use the rental income or some of the operational efficiencies that you have in the other properties to take care of that problem. It may be money, it may be people to help fix an AC. If you already have a team in place that's really working with you on that existing portfolio, it's much easier to add that extra one or take care of that one of the big ones of the entire set to be able to just address that problem pretty easily. The other thing is that you can buy a whole bunch of different houses at different types. There's duplexes, triplexes, fourplexes, and they're ranging in different quality of build, right? So you could buy a property that maybe is on the older side that may get you some more cash flow because there isn't very many homeowners there. The renter population is higher in that area, so you may get more rental income than appreciation. And then on the other end, you can have more of a long-term investment that is an appreciation play where you're maybe just breaking even or making a few dollars on it. And then you have the whole spectrum in between. So you get to kind of play with it, right? If you have a portfolio of properties, and that can only be done when you're investing out of state. So I think that that's really good. And the other thing too, is that when you're investing out of state, you're forced to use a team and think like a business. When you're thinking like a business, that means you're leveraging other people instead of using your own time to go out there and drive around and find property. No, that shouldn't be the way that it gets done. Really, what you should be encouraged to do is hire the right people or work with the right people who are motivated and have the same interests as you. So that could be someone who is, for instance, looking to transact on a property with you. And so they're hungry to find you a property to buy. So if you give them great criteria, they'll be really motivated and they know the areas better than you will. Even if you fly out there to go look at the market, they're going to know it. So it's really important to leverage those people and think in terms of leverage. You may be able to do things your own way, but there are people out there in different markets who can do things better because they've been around, right? And they know that market, they've lived there, and they're the pros. So being out of state investing means that you're not going to be able to put your hand on the property directly, but it does mean that you'll be able to leverage people who know how to do it and do it successfully. So I think those are really two key important things to remember about why investing in real estate is important. The other thing too is that you also have a selection to the entire United States. If you're leveraging the internet and leveraging a team abroad, you could buy properties in several states if you really wanted to. I don't recommend that, but I definitely recommend building portfolios across different towns or metro areas in the United States, because each metro area rises and falls and gets cheaper and more affordable, or it goes up in price. And so you can kind of use that to your advantage by having teams in multiple areas to move properties around and buy and sell. And so it's really smart to be able to have the whole country open to you instead of just having your own local market. So I think getting used to that, getting used to those things, and then the risk mitigation on top of it is really, really important. Now, here's one thing I do want to get into as well is let's talk about the actual mechanics of what a property looks like in a coastal city versus what it looks like in a Midwestern city. So I'm going to go ahead and share my screen, and this is an image from my book as well. So hopefully you guys should be able to see this. Okay, good. So you should be able to see this. This is figure 22 in my book that is called Part-Time Real Estate Investing for Full-Time Professionals. So feel free to pick that up on Amazon. You can just search my name and that would come up. But this picture clearly depicts what the difference between a Midwestern city or a coastal city is and versus a coastal city versus a Midwestern city. You can see here the strong difference in purchase price. I basically took this from my local knowledge here because I live in the San Francisco Bay Area, and obviously that might be an extreme, right? Like I know that some of you may be living in places where home values aren't $1 million to buy an entry-level house, but I'm doing this just for example because there's all kinds of shades of gray, and I just want to show you that there's power in thinking to invest outside of your market, especially if you live in an expensive one. So if you have a house here locally, right, that goes for $1 million, and let's say the rental income you could probably charge is somewhere around $3,500 a month, the rent to price ratio, all you do is you take the rental income on, per month and divide by the purchase price is only 0.35. That means that every month, on top of when you collect the income, you've got to pay the mortgage, you've got to pay taxes, you have to pay your property manager, you have to pay insurance, you have to pay maintenance, all of those things, right? So your cash flow is not very high. You're probably going to be in the negative. You're going to be paying more for the financing to hold that property because the income coming in won't cover all of the expenses for you. Yes, you're probably going to get terrific appreciation. So that's why over the long term, it's wise to consider these investments. But the problem is if you come into some sort of hiccup down the road and you need some money, you're going to have to write a check every single month for this guy. You're going to have to write a check waiting for the appreciation to go, and then you can sell and make your money. The problem is, as you're waiting for that to happen, you could be in a world of hurt. So what I like to do is I like to invest on this side of the page. I like to invest in markets where there's positive cash flow no matter what you do, because the rent to purchase price ratio is so much more in favor, because you have a house that you could buy for $100,000 instead of $1 million, and it will rent for $1,000. So the rent to price ratio is much, much favorable. It's 1%, right? And the appreciation isn't as high, but the great thing is that you get to pick the opportunity as to when to sell. Because you're not bleeding every month, you're able to decide, okay, this is the right month for me to sell. Or you can say, you know what, it's not really the right, I have no reason to sell, so I'll just hold on to it. So as you hold on to it, you're collecting cash flow, you're having your tenants pay for your mortgage, your taxes, your insurance, all of your expenses. And then you also get a little bit of appreciation on top of it. This is one thing that I really want to stress to you guys too, is that look at these two houses here. One of them is $1 million and one of them is $100,000. If you had 10 of these guys, right? So let's say you had $250,000 in the bank. And if you did, congratulations, lucky you, let's talk. But if you had $250,000 in the bank, you could afford one of these houses, right? Or you could afford 10 of these guys. 10. You take the $250,000, you divide it by 10, it's $25,000 down payment for each one of these individual houses. And your cash flow and your value in 5 years is going to be so much more, it's going to be so much easier than working with this, because tenants come and go, right? And so you may have one house that's down or needs repairs. And so you have the 9 other ones to help make up for that. Whereas over here, if your tenant leaves, not only are you out $3,500, you're still bleeding anyway, even if you had a person in there. So you could be losing $4,000 a month without a tenant in here. And in markets that are in the coastal zones, the western coast and the eastern coast, those markets tend to have more favorable tenant laws as well. So that means that you could be sitting with an empty house for longer, or with economic vacancy, which means there's someone in there but not paying. Whereas in these Midwestern cash flow markets, the legalities there are more friendly towards landlords. And so you can get people out if they're not paying rent in about 20 days. Whereas in California, I just went through an experience where it took me 5 months, and I was like pushing it really, really hard. So I would say that this is something to strongly consider why out-of-state investing is right for you. We're also seeing too, let me go ahead and end the sharing. But I also want to explain to you too that over time, we have been seeing a lot of this migration effect of people moving from urban cores out to tertiary markets because it's cheaper. People have the internet now. So in order to work wherever they want to work, they can still create the income or generate the income wherever they are. And they can live in a cheap market and live there and then prosper and get a bigger house and do all that thing. So by opening yourself up to the entire country, you have so many different metro areas open to you where that effect is happening, and you can take advantage of that for sure. So I just wanted to point that out to you. I think that that's really, really important. Now, real quick, in the next couple of minutes, I'm going to talk to you about how you can go ahead and start doing this. I'm going to be generating a course a little bit later on, and I also have coaching available too if you want to talk more about this, or if you just want to talk one-off and try to figure out what your options are. I'm here. Just go ahead and write something in the comments, or reach out to me in YouTube or Facebook. I'd be more than happy to continue the conversation on a personal basis to try to figure out what works for you the best. But here's what I would recommend if you guys want to start investing out of state and don't know where to start, okay? First thing is you got to pick your market. So you got to do some research. You got to go out there and figure out, okay, I have the whole country open to me, or world even. And so where am I going to start to invest? So you got to look at job data, right? That's one of the first things to look at. There's a lot of resources out there. There's a Bureau of Labor Statistics. You can use Google as well to help you to find unemployment data and employment data in different sectors for areas across the country. I would highly recommend that you consider areas that you've either lived in or you have families there, because having that support in those markets is really, really important, because then you could fly out there, you can stay with your friends or family for a little while, and you can do some work and write off the trip as soon as you have a few properties under your belt in that new market, right? Plus, they can be your eyes and ears for you, and they can meet property managers for you while you're not there, those types of things. So I would think outside the box in terms of that. Then you got to look at population, jobs, and median incomes. So those are the three things to look at. I won't go more into it here because this is a live stream, and I think these are things that we can talk about a little bit more and get into the details for forever. So I'm just going to stop right there and then move on to the next step. Once you've selected what market you want to go into, the next is to determine your asset type and what your risk tolerance is. Because as you saw over here in this example that we just pulled, there's two types of properties. There's appreciation type properties that are expensive and they won't cash flow very well. So you'll maybe break even every month or even have to write a check every once in a while, right? Those properties are properties that have responsible tenants, tenants that are looking for deals, tenants that understand, their financial situation and they want a deal, and they live in nice houses, right? Those nice houses are in demand, so they'll go up in value over time. Or there's the cash flow side, which is you have people that have no problem kicking in the drywall when they're upset with you because they have to pay their rent, surprise, surprise, every month. Or they constantly have problems with the toilet or the plumbing because either the house isn't well cared for or they're dumping oil down it. And you just have a different type of tenant class. But those types of tenants end up paying more for the purchase price. So you get kind of more of a cash flow effect. So where you are in that spectrum, you kind of have to weigh out, like, are you a high risk taker, high return seeker, or do you want low return and just appreciation and you're willing to maybe write a check every once in a while? You have to figure out where you are in that spectrum, and there's all types of shades of gray. When I started, I wanted like right in the middle. I wanted to buy properties that had a little bit of both components, and so that is out there. You just have to communicate that to your agents when you're saying this is what I'm looking for in terms of my buying criteria. Then, so step one, you select your market. You know what markets, and I would recommend 2 or 3 that you do that. Once you have your 2 or 3 markets, then determine what type of risk tolerance is right for you. Then the third step is underwrite properties. Underwrite a lot of properties, because what you want to do is you want to appear impressed you want to be in a position where the people that you're working with are impressed with your knowledge, right? Even though you don't have a property yet, you want people to look at you and say, boy, this guy knows what he's doing. He already has done his homework. They must be really serious. I'm going to give this guy a lot of attention and make sure I work really hard for him because he's going to close on something, right? That's what these agents are thinking. So do a lot of property underwriting. One thing that I'm going to also offer to you guys in Facebook or in YouTube, if any one person comments, then I'd be more than happy to share my underwriting sheet with you. And I want to show you what that looks like here and how that works. It's free. And I put a lot of time and energy into this, but I do want to show you what it looks like. So here it is. This is my single family analyzer and Burr analysis sheet. And what this allows you to do is it allows you to put the MLS link here. You can put the size of the house just for reference later. And then you can decide, all right, what is the asking price? What's the purchasing price? Do I want to finance it or buy it cash? And then do I want to refinance it out later? And you can enter in some of these terms, and then it spits out all of your fundamentals, what type of, how much returns you're going to make based on the information that you put in here. Everything in blue is editable. Everything in black is calculated by a formula. And so then you got to enter in your rental income info, but it should give you some return. So if any one of you out there wants to have this, please just comment in the sections in either Facebook or YouTube, wherever you're watching, and I'd be happy to paste it in there for everyone. So please go ahead and do that if you are interested, okay? Now, that being said, once you have the market selected, you've determined what your asset class is and how much risk you want to take and what type of properties you're going to buy. Now you underwrite a lot of properties. The next thing to do is once you've underwritten a lot of properties, you have some market knowledge. You understand what it is that you're doing and you're selecting your criteria. That is the fourth thing. You select your criteria. You say, I want properties in this price range to this price range from 100,000 to 80,000, and I want the rents to be 700 to 900. That's what I want. 2 or 3 key criteria principles. Then you start dialing. You start talking with agents. You start telling what you know, what your criteria is, and maybe even if you're looking for extra credits and maybe even a gold star, you fly out to the market. You fly out to the market, you set up times to meet with the guy or meet with the gal and talk through your criteria and get to know them a little bit better face to face. And maybe you'll find a connection. Maybe there'll be a personal connection. Maybe your kids go to the same school or something like that, right? Or people that know each other and so you have common mutual interest. So that's what I would do. And by the way, I would also, if you know investors that are already investing in the area, tap them to help make referrals to you so that you can just go ahead and start talking with them. And if you don't have any people that you're getting in touch with, or you don't know anyone in the market that you're going to be investing in, let me know. I may have someone in my network that I can connect you with that can give you a few pointers as well. So then the last thing is continuously underwrite. So continue to underwrite with your criteria. And now that you're talking with an agent, you're going to be getting some good information, some good market insights. And once you're underwriting properties, you're starting to talk with the lenders. Now you're getting property managers involved, and you're talking with agents and brokers, and then your lenders, your contractors. You're going to have to get that whole team all sorted out. But the good news is that once you find one really good person in that market, they can make referrals to you for property managers, for lenders, for contractors. They know all the people because they live there and they live and breathe this stuff. So they love it. So that's all you got to do is just reach out, start getting referrals, get your feelers out there, and then you start underwriting lots of properties that come your way. And when you finally find one that meets your criteria, and everything checks out, all the crime around the area is good, the purchase price is right, the numbers make sense, it's time for you to execute and make it happen. And a lot of people, unfortunately, they get stuck at this phase because they're kind of nervous about how it's going to all work. And that's where someone like me or another investor can come in and help you and walk you through and just reassure you that everything's going to be all right. It's okay writing that $20,000 to $25,000 check. It's going to be fine. So anyway, I hope that this was helpful for you guys. I just went ahead and kind of talked about how important out-of-state real estate investing is. And for me personally, I've used it to great success. I built, 14 units in my first year investing out of state using this system. And these properties have been the blessing of my life for sure. They've contributed more to my net worth than any of my other investments that I've owned by far. And it really has been a benefit because I have some good friends now, and I've got a lot of good contacts out in the area. And now I have a way to build my portfolio even more because I've built those contacts out there in that market. So that being said, you guys, I'm going to go ahead and end the stream here unless there's any other questions. And I did see someone on Facebook say that they would like to see that. So I'll go ahead and post it on Facebook. And if anyone out there is on YouTube and they listen to the end and decide that they would like a copy as well, I'll go ahead and post it out there at the same time. So that being said, you guys, that is it. For those of you who are watching me live, have a fantastic weekend. And for those of you that are watching this broadcast after the fact, have an awesome rest of the day, and reach out if you have any questions. We are here for you, and we are vested in your success. Take care, everyone. Have a good day.